Hey, I'm Jake Hoskins. Thanks for joining me today. In this video, I'm going to be going over the fundamentals of investing. So what is investing and how and why you should be doing it. Now, it's a subject that often gets overcomplicated and intimidating, and the fact is it doesn't have to be that way. So sit tight, pay attention, and if you do, you'll be a millionaire in 1 week.
False.
Investing is when you commit a sum of money up front with the expectation to receive more in the future to compensate for your risk and time. Now, you have to be compensated for that risk and time, otherwise you're just gambling. And unlike gambling, investing doesn't involve a instant binary outcome of win-lose. It usually takes time, and an outcome for one investor may not be a good outcome for another investor. So investing takes time, it takes patience, but I know everybody can do it. You just have to study and be disciplined and you'll get the hang of it. Now, I see a lot of people that don't want to take the time or the effort it takes to be successful, and that's why they elect to day trade. And I'm just here to tell you day trading is a really bad idea. So I'll go into more depth in a later video about day trading, but in the meantime, just don't do it. So when I gave my definition of investing, I mentioned that you had to be compensated for your risk. Now, what exactly is risk? Well, I think of it as the amount of danger that you're putting your money into, potentially, when you make a certain investment. It's the likelihood of a bad outcome. Now, I'll give you a gambling example to simplify things. Let's say you had to bet $1,000, and you could either bet it on a 16-horse race or a coin flip. Now, which one would you bet on? Well, it depends on the outcome, right? Let's say they both paid out $2,000 for a correct pick. Obviously, you would go with the coin flip, right? But why would you do that? Well, it's simple, because your likelihood of a correct pick with the coin flip is 1 out of 2, whereas the horse race, it's 1 out of 16. So how could we make these bets more even? Well, we'd have to balance out the proportion of risk to reward. In the coin flip, if it paid $2,000, then the 16-horse race would have to pay out $16,000. Now these bets are equivalent in risk and return. Now that risk and reward are balanced out, it only depends on your preference. So do you want the riskier, higher payout, or do you want the more sure thing? That example is an illustration of how inseparable risk and return are, and that carries the same in the market. So a higher risk company, you're going to require a higher reward. So a good investor is looking for the highest return in comparison to how much risk it has. So you want a higher return to risk ratio, and if you look for those and you consistently find them, you're going to do really good in investing. Now that you know what investing is, what should you be investing in? Well, there's several different asset classes, also referred to as securities, and the main one that we all know about is stocks. Stocks are an equity instrument, which means you take partial ownership of the company. It may just be a very small fraction, but nonetheless you have the benefits of the other owners. That means voting rights, and that means claims to certain profits. Now, the way you can make profits on stocks is with capital gains, which means when the price goes up, then your investment grows, and you have to sell it in order to realize those profits. Companies can also pay dividends, which means they distribute a share of of their earnings back to the shareholders. So the second type of security you can invest in is bonds. And I'm sure you've all heard of bonds too. Bonds are where you loan money to somebody, and so you become a debtor and they become the debtee. So you can loan money to a lot of different institutions. The government, which is called a government bond or a T-bill. You can loan to different corporations and companies. Those are called corporate bonds. And you can also loan to cities or states, also called municipal bonds or state bonds. And often those are tax-free. The advantage with bonds is that that person has to pay you the interest payments. Unless they go bankrupt, they have to pay you. So that's an advantage over stocks, is that they have that stability and that low risk. Now, some bonds can still be high risk, but most of them are generally lower risk than stocks because they have to pay you those premiums, those interest payments every month. There you have the two main securities that you can invest in, stocks and bonds. And most every investment product that you'll see is made up of those two things in some way or proportion, but they're all kind of a mix of debt and equity instruments. The next asset class is real estate. Now, real estate isn't really in the stock market per se, but you can invest in it. Real estate refers to buildings, land, anything that's tangible. That's real estate. So people invest in real estate because it's not going anywhere. And oftentimes the value still goes up. And sometimes you can rent out a building or something like that, and the tenants can pay you sort of like a dividend or like a bond payment is when they pay their rental income. So real estate has the advantages of stocks and bonds depending on what kind of real estate you're investing in. So beyond stocks, bonds, and real estate, there are mixed asset classes. Those just mean that they're a mix of stocks, bonds, or real estate in some kind of proportion. These include mutual funds, ETFs, and REITs. Now, mutual funds are just a big mix of stocks all in one basket. And they give you diversification that's easy and cheap. And that helps spread out your risk across a lot of different stocks. A lot of mutual funds also have bonds in them to create kind of a whole portfolio for a low price, and there's just a manager managing it for you, and you just pay a small management fee. The next mixed asset class is ETFs. Now, ETFs are basically mutual funds that have been chopped up into a bunch of tiny pieces, and they're exchanged on, let's say, the New York Stock Exchange or other stock exchanges out there. Mutual funds, however, are not exchanged on stock exchanges. You have to buy them straight from the creator. Another mixed asset class that I mentioned is an REIT. REIT stands for Real Estate Investment Trust, and that just means that the investors that invest in this create a big pool of money, and then a real estate investor or real estate firm takes that pool of money and invests it into illiquid real estate. Now, that real estate generates income and capital gains for them, and then they in turn redistribute it back to you, the shareholders. Of course, there are other alternative investment vehicles too. There's hedge funds, options, commodities, futures, all different kinds of things, and I'll go into some of those in later videos too. But you have all these choices to invest in, and you can pick any of them that you want to in any proportion. Let's say you have $1,000 in cash that's just burning a hole in your pocket, and you really want to invest it. What do you do? What do you invest in? Well, there's a lot of different options. So do you put it all into one stock? That's probably not the best idea. You want to diversify. Now, diversification, as I mentioned earlier, just means spreading out all your money, and so you don't have all your eggs in one basket. That's a good idea because it helps you reduce your risk. And when you're building a portfolio, you want to diversify across a lot of different things like size of the company, different asset classes, different time periods, all kinds of things that you can think of. You want to diversify across them so that you're not overexposed to any one danger. When you're overexposed to certain risks, that just makes the risk of your overall portfolio higher. And as we talked about earlier, you want as low of risk as you can possibly get for the highest return. So now that you've built a portfolio that matches your investing preferences, what should your goals be long term? Well, you should be looking to build wealth over time. You shouldn't be looking to get rich quick, because that's just going to result in a crash and burn. When you build and protect your wealth over time, it just makes your life a whole lot easier. So you can have more freedom to go on trips and to live comfortably and just to do whatever you want. You can make charitable donations. The fact is, you can't help others unless you help yourself financially. Investing can be confusing and sometimes frustrating, but if you get the hang of it, it can be a real blessing on you and your family for the rest of your life. Thanks so much for watching. I hope you learned something from this video. If you did, just like the video and leave a comment about what you thought was important. If you hated the video, just go ahead and leave a negative comment. Feel free to subscribe to my channel. I'm going to be doing financial and entrepreneurship related content. Have a good day.